Last week, I executed a clean 1 to 5 risk to reward on USD JPY using a simple mechanical supply and demand process. No indicators, no cutscene, just structure, liquidity, and one confirmation. I will break this down the exact same way I teach in mentorship. Clean chart, no clutter. First, here's the MT5 screenshot of the actual execution so you can see the exact entry and exit. First thing I want you to keep in mind, every point of interest needs a buildup of liquidity. Otherwise, your point of interest will be the liquidity. As you can see here, would you pick this zone, this demand, or this one? This is simple to identify. If you can throw a trend line on it, then it is a liquidity. And this zone or this demand becomes smart money trap, SMT. Price took liquidity from the high, then price will come back. Price needs to retrace back. If you see, we had higher high, higher low, another high, but this one is liquidity for the price to keep going up. Everybody teaches something like this: higher high, higher low, higher low, and higher high again, and higher low and higher high again. This is picture perfect uptrend. It does not happen like this. It happens like this. Do you see? The fact that this low is broken does not mean that price will keep going down. No, this low was broken by this low, so this is an inducement and this is a liquidity. So this low becomes a strong low again to continue price to the upside. Now simply what we are expecting is maybe a reaction, something like this, then break, mitigate the true demand, give us market structure shift or change of character, then go higher. It is as simple as that. So let me show you exactly where I took this trade. On 15 minutes, price was going higher high, higher low. As you can see, this is still inside this higher high. So new high was created here, and this is higher low, and this is the highest high, as you can see. Now, which zone would you pick? Two things you should consider: this demand have huge candles, as you can see, huge Maraboso candles, and this demand is not big as this one. As you can see, this demand, these candles produce low probability or small candles. And another thing you can consider is it has a lot of wicks. As you can see, you can throw a trend line on it. So this demand, as you can see, this demand is part of this liquidity. So this is a smart money trap, and it becomes a liquidity to mitigate the true demand over here. A lot of people would take a trace from here. Sometimes it will give them fake market structure shift, then chop down to mitigate the original demand. For a retracement or pullback, you need at least two candles. As you can see here, if you look at this example I drew, you need the first candle that retraces back, then the next candle closes below this candle. Maybe if not the next candle, maybe the third or fourth or fifth, it doesn't matter. The important thing is the first candle that is bearish. Let's say we are going up, the first candle that is bearish, we need one more candle to consider it lower high or retracement or pullback. Let me zoom in. See here, this is the first bearish candle. As you can see, was broken after 1 2 3 or third candle. So this is a valid pullback. But if you look again, we have a lot of wicks. It can fit into a trend line much different from this retracement or pullback. As you can see, first bearish candle, then the second candle or next candle breaks it low. This is a pullback. As you can see, a retracement. If you look here, there was one bearish candle. Price failed to break the low of this bearish candle. So this is not a valid pullback or retracement. That's how you identify a higher high, higher low. You can look at this one, but it did not break the high. It failed to break high. So we cannot consider this one. Price first must break the high, make new higher high or low low. In this case, higher high, then pullback. That's what we consider a retracement or pullback. But price is still in this leg, as you can see. If we mark the higher high, you see no break. So this means it is part of this leg, not a retracement. The second reason we pick this zone, because this one has an imbalance and this one was mitigated. As simple as that. Now let's move on to the entry after inducing this low and mitigated the demand. As price returned into demand, I waited for one confirmation, a clean market shift in structure, not an OB break, not a random wick, a clean shift with displacement. Usually what we look for is something like this. and trade this zone, for example. But in this case, it's very different. Let me zoom in so you can understand it better. Focus here. We have imbalance, as you can see, before mitigation of this higher time frame demand. This imbalance comes from a supply, as you can see, and the supply is this one, is this candle. We can pick the both candles as a supply, and the supply was broken, as you can see. I took this as a market structure shift. I made sure not to miss this one. I added some buffer to the entry and target 1 to 5, and it easily hit take profit. So that's it for this video. If you got any value, make sure to like this video. And if you want to learn this exact mechanical approach with my markups and weekly trade reviews, the details are in the description.